Hey everyone, and welcome. Today, we're diving into a really cool part of accounting, one that deals with something every business faces: uncertainty. We're talking about contingent assets and contingent liabilities. Trust me, understanding these is absolutely key to seeing how companies prepare for a future that's, well, not always predictable. So, a lot of people think accounting is just a history lesson, right? Recording sales that already happened, paying bills from last month. But what if I told you it's also about trying to gaze into a crystal ball? A company's real financial story isn't just about the solid numbers it has today, but also about all the possibilities and the what-ifs it's facing tomorrow. So here's our game plan. First, we'll talk about why accounting even cares about an uncertain future. Then we'll break down contingent assets and liabilities. The real fun begins in Section 4, where we'll get super clear on the differences between some tricky terms. And of course, we'll finish up with a quick recap and a quiz to make sure it all sticks. All right, let's jump right in. With this first section, we're officially moving beyond the world of simple debits and credits and into what I like to call the gray zone of financial reporting. This is where things get interesting. Here's the bottom line. Accounting might be built on past events, but to give a truly honest picture, it has to acknowledge the maybes. We're talking about potential wins or potential losses that could seriously shake things up for the company down the road. It's all about being transparent with investors and managers about both the risks and the opportunities that are lurking around the corner. So first up in our world of maybes are contingent assets. You can think of these as potential good news, possible streams of income for the business. But as you're about to see, when it comes to good news that isn't a done deal yet, accounting is extremely cautious. Okay, here's the formal definition. I know, it's a mouthful, but let's break it down. The magic words here are possible asset. It's not a sure thing. It stems from something that already happened, but whether it actually becomes a real asset depends entirely on some uncertain future event that the company has zero control over. So, let's put that in simple terms. It's a possible asset, not a guaranteed one. It's connected to a past event, but we only find out for sure in the future. And crucially, the outcome is out of the company's hands. The absolute classic example, a lawsuit. Imagine your company is suing another company. You might get a big payout, but you might not. It's all up to the court. And this is the million-dollar question, isn't it? I mean, if there's a chance you're going to get a big pile of cash, why not put it on the books? It would make the company's financials look great. Well, there's a super important accounting rule that basically screams, hold your horses. And that rule is the principle of prudence. You might also hear it called conservatism. All it really means is don't count your chickens before they hatch. It would be totally misleading to record income that might never show up. So the smart or prudent thing to do is be cautious about potential gains. So what's the actual process? Well, a contingent asset is not put on the main financial statements, like the balance sheet. Simple as that. It only becomes a real recorded asset when getting that money is virtually certain. Now, if the inflow is just probable, meaning it's likely but not a slam dunk, it might get a mention in the director's report, but it stays firmly off the official books. Okay, so we know how to be cautious with potential wins. Now, let's flip the coin and look at the other side, potential losses or possible obligations. These are called contingent liabilities, and as you'll see, accounting treats them very, very differently. Now, this is where it gets really interesting, because this definition has two parts. A contingent liability can be, 1, a possible obligation, like a lawsuit someone has filed against your company, or 2, it can be a present obligation that you can't recognize yet because it's not likely you'll have to pay, or you just can't come up with a reliable estimate of the cost. This example makes it super clear. So Mr. X sells a machine. That's the past event. Sometime later, Mr. Y gets in an accident and files a claim for damages. Boom, that's the possible obligation. But whether Mr. X actually has to fork over any money, that all depends on what a future investigation finds. It's a textbook contingent liability. See the difference in treatment here? Just like contingent assets, these liabilities are not recognized on the balance sheet. However, and this is a huge however, they almost always must be disclosed in the notes to the financial statements. The only exception is if the chance of paying out is incredibly remote. And get this, if the situation changes and it becomes probable that the company will have to pay, it gets an upgrade from a simple disclosure to something called a provision. More on that in a second. And that brings us to what I think is the most important part of this whole topic. Seriously, understanding the subtle differences between a regular liability, a provision, and a contingent liability is what separates the pros from the rookies. It's all about the degree of certainty. Let's put two of them head to head first. A standard liability is a present obligation. You know you owe the money, like a bank loan. A contingent liability, on the other hand, is only a possible obligation. See the difference? With a liability, paying out cash is pretty much a guarantee. With a contingent one, it's not. So what about that middle ground I mentioned? That's a provision. A provision is a present liability. You know you're on the hook for something, but you're just not sure about the exact amount or timing. The key is that you can make a reliable estimate. A perfect example is warranty claims. A company knows it will have to pay for some repairs. It just has to estimate how much. This table just nails the distinction. Look, a provision is a present liability, and it gets recognized on the balance sheet. Why? Because an outflow of cash is probable, and you can estimate it. A contingent liability is only a possible obligation, so it's not recognized. Why not? Because the outflow isn't probable, or you can't estimate it. Simple as that. And here's where it all comes together in the real world. Say a company is fighting a tax penalty. If, based on all the evidence and legal advice, management thinks, yeah, we're probably going to have to pay this, they create a provision. But if they think, you know what, we have a really good chance of winning this appeal, they just disclose it as a contingent liability. It all comes down to their professional judgment. Okay, deep breath. We have covered a lot of ground. We've gone through the key definitions and, most importantly, the distinctions. So in this last section, let's lock it all in with a quick recap and a few practice questions to see what you've learned. So if you forget everything else, just remember this. Contingent asset, a possible gain, so we don't touch it. Contingent liability, a possible loss, so we talk about it in the notes. Provision, a probable loss that we can estimate, so we record it. And a regular liability, a certain loss, so we definitely record it. All right, quiz time. First up, true or false? A contingent liability need not be disclosed in the financial statements. Take a second. What do you think? That one is definitely false. Disclosure is the name of the game for contingent liabilities. It's how you warn people about potential risks, unless the chance of it happening is basically zero. Question number 2. True or false? A claim that a company is pursuing, meaning they're the ones suing, is a contingent liability. And that is false. Tricky, right? If the company is pursuing the claim, they stand to gain money. That makes it a potential inflow, which is a contingent asset. Okay, last one for all the marbles. True or false, when it is probable that a firm will have to pay something, it creates a contingent liability. And that is also false. Remember that trigger word probable. As soon as that payment becomes probable and you can make a good estimate, it graduates. It's no longer a mere contingent liability, it becomes a provision and gets recorded on the books. And that's a wrap. So I'll just leave you with this to think about. Next time you look at a company's financial report, don't just look at the big numbers on the balance sheet. Dig into the notes, because understanding a company's maybes, its contingent assets and liabilities, gives you a much, much deeper look into its real story. Thanks so much for joining me.